All right, welcome back to episode 38 of the Kansas City Commercial Real Estate Market Pulse, sponsored by Midwest Commercial Real Estate Advisors. That's us. That's our firm. We're here in Kansas City. And for the last couple of weeks, Mitch and I have been discussing with many prospective clients everything around 1031 exchanges and return on equity. Return on equity being what I'll call just a return metric that a lot of investors aren't really utilizing and thinking about, specifically in markets and in properties that they've owned for a long time, but markets that have highly appreciated. As everything's gotten more expensive, we have not, in commercial real estate, passed all of those increases or in expense over to our businesses or the residents that live, work, play in our buildings. And so we also have been the beneficiary of rising prices. If you own real estate, typically the real estate value goes up. It doesn't always happen that way. And so you find yourself in a position where you have more equity in a property than you did when you first purchased it, but the return has not increased in a pro rata position that is still feasible to be I would say happy with. And so many people have been reaching out to us talking about, hey, can we analyze their properties and really help them understand if they have the opportunity to reach, to really unlock this equity. And so that was a focus of ours for the last 2 or 3 weeks. And we're proud to say probably 7 to 10 people have reached out. We've had good conversations, some that are just thinking about it, some that are actively looking to engage with us to find properties. And so we thought it would be a good idea today to bring to all of those listeners and prospective clients an overview of the Kansas City multifamily market. So Mitch and I have been spending some time diving deep into the numbers and figuring out what's listed. And I'm excited to kind of dive into this because Kansas City continues to evolve as one of the most balanced multifamily markets in the country, right? Institutional capital and private investors are both active. We're seeing it on a regular basis. We have done some tracking of those trades here recently, and there was a massive deal done in the Kansas City metro area, over $100 million, which if you follow me on LinkedIn, I posted about a week or so ago, not that deal specifically, but about where capital is flowing, which is these trophy large assets, right? And typically not into Kansas City, but we are attracting some of that institutional capital, which is good to see. But alongside me today is Mitch Case, and Mitch is very well versed in the multifamily market, and he's been tracking every multifamily asset on the market across the metro. And today we're excited to kind of share what that data is telling us and where the opportunities are emerging. So Mitch, I'm going to let you get right into it, brother.
Yeah. Well, I think it's important just to kind of iterate the fact that this is a snapshot. So this is always going to be kind of ebbing and flowing depending on what day you're looking at this. So, at the time when we took a look at this, we had a little over 65 multifamily properties. And this is in various different sizes that were listed at one time. And throughout this is all marketed data. So keep that in mind as we kind of go through this. But that does equate for just a little over 2,500 units within the Kansas City MSA area, and roughly about $195 million worth of listings right now. So that's what it looks like from a snapshot overview side of things. But when we start kind of diving into, what people are looking for, how that's going to look when I want to run my metrics, how do I know if I'm going to go value add or just buy something that's more stabilized? We start kind of diving into this. And a lot of that's really going to depend on, what's my average price per unit? What can I actually afford? What's that cap rate going to look like? And then, where am I actually going to be buying? Where are those numbers going to work the best? And so with this quick market metric right now, of those 2,500 units, average price is around 92,000 and some change. Keep in mind this cap rate, you're going to sit there and say, I've never seen an 8 cap on multifamily in the Kansas City area before without some significant value add or outlying areas outside of the major metro. These are marketed. So these are cap rates that, we need to dive into the details a little bit more. And if, anything that does interest you in this space, like we want to work with you guys to help underwrite this, to truly understand what's that deal cap rate versus market cap rate? And that's something that we're able to dive into. But I think what's continued to be the case is you've got a lot of properties on the Missouri side versus the Kansas side. And you can kind of see that, almost 75% of those are on the Missouri side of things. So we'll kind of dive into that a little bit more. But these units are going to be varying from, 100 plus units to down to more of your mom and pop private investors that are just a few units that kind of are the get started. But I think, Logan, kind of what you had mentioned earlier is like, it's such a diverse portfolio across the board in the Kansas City area, where you have the institutionals coming in and buying large scale projects, while also, the entry level multifamily. Hey, I've been doing single family for, 5 or 6 years. Now I want to kind of take that next step into commercial, and multifamily seems to be that next step for most investors. But what you kind of is shown here in the middle, you've got a lot of properties in that mid-size area for a lot of this equity that's been unlocked over time to really just kind of figure out, like, what is my strategy? How much equity do I have based on what I've seen my existing portfolio increase? What can I get the most out of that return on equity? And so you're just going to see a lot of those mid-sized properties kind of being that target focus for some of those individuals that have unlocked some equity that they need to deploy.
Yeah, most definitely. And I think that the diversity of the deal size tells us, that there's an opportunity across the risk return spectrum, right? And so it's not just for institutional players, but it's also for private and regional investors. I mean, that mid-tier segment is the bridge, it's big enough for some institutional underwriting, but it's small enough for creative financing and fast repositioning. And that's where we're advising most of our clients to kind of focus their time right now. But you always, in most of these conversations that we have with these investors, is really all about like the risk return spectrum. It's like I've often said that there's nothing passive about actively owning real estate. And Mitch, you were just in the office with me here a second ago. We're talking about, the first question we need to ask this 1031 client later today is, hey, how much time do you have? And how often do you want to be dealing with a property that is in Missouri or Kansas and you are on the West Coast, right? And so I think that is a very important facet to kind of be thinking about. And each one of these properties gives you a different risk return kind of spectrum, right? And so we can help you walk through what's the benefit of having a small 1 to 19 unit property versus having that 100 unit, Class B or Class A multifamily property. Sure, that's going to be more expensive. Cap rate's probably going to be compressed, but you likely will have less work to have to actually do on a property of that size. And that is a very important decision and a big criterion that we utilize to help our investors start to make these decisions. Obviously, you can go into other asset classes as well that could be more hands-off, or lease structures, such as triple net leases. But today we're talking about the multifamily side, and even within that asset class, you have small, mid, and large scale properties, and each one of them gives you a little bit of a different opportunity to invest in and figure out, depending on your time and experience levels, right?
Yeah, absolutely.
So let's go into the price point analysis, because I think this is something that might actually, surprise some folks, because we always talk about, Kansas City being affordable, and it's kind of wild to think about, this price point around $93,000 a unit being affordable, right? I mean, some investors that were active 10, 15 years ago, they were buying properties at $20,000, $30,000 a door, right? But I mean, if you're developing new properties across the country and you deliver a new property that's 100% or 90% occupied, likely that's going to be $250K plus per door. So when you think about it from that perspective, you still can get in Kansas City at a pretty good price per door. Mitch, talk to us a little bit about that.
Yeah. And I think one of the biggest challenges with this right now is just the variance between what that price per door is when you start looking at it from a building perspective. Because I mean, from this, we're talking about some of those entry level being at, $10,000 a door. And oftentimes we think, hey, that's the best route to go. But obviously that's going to probably be an outlying area. Might be really hard to find tenants, probably going to have to come up with a lot of value add construction costs on the front end. So what additional funds do you have to bring to the table, not only to close and own it, but to actually get these units up to a place where you can actually have people inhabit those locations. But all the way up to the more of the institutional side, which, this one kind of blows my mind because I'm just not in that space necessarily, but, 435,000 per door on the high end. Those are going to be some very high dollar premium luxury type investments that can come in there. But I think the biggest thing that really stands out to me is the opportunities that you have between just positioning your money into something that is less of an active involvement in your portfolio and something that would just be more of the passive side. Do you want to hold off from making those phone calls, having additional, not necessarily just a property manager, but just being actively engaged in your property? And there's a lot of those that are out there, but obviously you're going to be at that higher price point for that privilege to have that, while at the same time, you're probably going to be buying, as you said, at a higher cap rate.
Yeah.
From the value add perspective, I mean, there's still, plenty of properties out there, but, it's not a plug and play scenario when you step into those smaller units, unit counts that maybe bring a lower price point per unit as well. Like those are going to be some actively engaged, actively involved investment strategies. And I think that's where, I really want to advise individuals that are either looking to get into the multifamily side of things or those that are unlocking that equity, that you really need to be able to hone in on what is your strategy? Why are you going after this? And that allows us to have a better idea of what price point is actually going to be the best for you, what specific asset that's being listed or unlisted is the right way to go. So I think that's really needs to be honed in on the idea that, what is your active investment? What is your activity that you want to be involved in those investments to really understand where that starting point is for you?
Yeah, most definitely. I mean, with our average price per unit being around $93,000 a door, the range is still really extreme, right? I mean, you can get properties down as low as $10,000 a door, all the way up to $435,000 per door. And so, I mean, I think that variance shows two very distinct markets, and that's what you're talking about, Mitch. But they're operating simultaneously. The institutional Class A world and then the entrepreneurial value add world. If you look at value add and investment grade under $200,000 per unit, we still have around 58 properties that are currently listed for sale for you to review. And so I think that these pricing spreads, they really do highlight kind of the different inefficiencies in the market and where smart capital can win. The biggest return are kind of oftentimes in those mid-tier repositioning plays that most overlook, right? I mean, because a lot of criterion that investors talk to us about is 1980s and newer. Okay, well, if that's the criterion in Kansas City, get ready to pay for it, because our multifamily stock is old and it is older, and we're an old city. And, I think that, specifically in areas like revitalizing, I can't say that word today, revitalizing downtown and urban core areas where you have a lot of young professionals wanting to move to, those assets might be older in nature, but they typically have gone through, and the mechanicals and electricals and plumbing have been updated, right? So definitely want to make sure we highlight that fact, but the spread is very different. And also, we didn't break this down necessarily, in regards to each one of those assets being on the Missouri or the Kansas side, but Mitch is going to talk to us now about kind of the geographic market breakdown. We mentioned earlier that Missouri has a lot more properties for sale than Kansas does, right now on the multifamily side, mostly because it's a much larger area, right? Sure, but also, sure. I think that, there are some different demand drivers for each one of those, states that we have in regards to the submarkets as well.
Yeah. And I think, from being local in this market and kind of knowing the geographical area, Kansas tends to be, and I'm specifically probably talking more Johnson County in the Kansas area, that is just kind of more of an affluent area. It's growing. It is spreading wider and wider and wider the further you go south and west. And so that's typically just going to bring, a higher dollar per door type of asset class or asset, because you have individuals that are expecting more from those specific properties, maybe not so much the individuals heading downtown to work by jumping on the streetcar or anything along those lines. Now, as you said, like with it being much Kansas City being a much larger geographical area, you're going to have the majority of those there. And obviously that price range, is really going to be dependent on which part of the city you are in, and which areas those are growing. But as everything continues to kind of grow south and west, is what it seems like, you're going to have just a lot more premium properties that you're going to be able to probably have newer builds, which is going to require a little bit less of that value add aspect, and parking that. Logan, I'll let you kind of dive into the development side of things, which is also a huge part of what is going on in Kansas City.
Yeah, absolutely. We have around 5,500 plus units being under construction right now, 3,400 in pre-lease, and about 11,000 units planned across the metro area. That being said, on an annual average, we're absorbing around 5,900 units, which is why specific areas in the Kansas City metropolitan statistical area continue to have some of the highest year-over-year rent growth. It's a supply and demand equation, right? And so we're adding, on average, around 25,000 people to the MSA on a yearly basis. And so where are those people going to live? And so obviously developers have been targeting Johnson County north of the river specifically for these multifamily properties. But it's good to see that the deals that are being developed and brought to market are being absorbed in the landscape of Kansas City. So I'm very proud to say that, obviously, and it's a good marker for multifamily in the Kansas City side. We do have some listener questions coming in, so thank you guys for all being here today, and definitely continue to ask our questions. Tim Gramley is going to ask a question, Mitch, to us. He's curious on how you're factoring in today's financing environments into kind of the price point analysis. Are we seeing deals pencil only when sellers adjust, or buyers adapting with creative structures? I think I'll take the first swing at that. It's a great question, Tim. One that we've actually done a breakdown, multiple sensitivity analysis utilizing Freddie Mac and Fannie Mae loans, which are in the 5% range, versus a bank loan, and specifically different leverage points. So I think from a creative standpoint, we have about 3 deals right now that are being somewhat creatively worked on with some sort of seller financing for a period of time to ensure that the NOI can get to a point where they can go and refinance. That's happening mostly on development deals right now. In regards to just true seller financing on a multifamily deal or something, we always can ask that question to the sellers, but most of the time they're looking for their cash out and just kind of move on from that property. But if they do want to get the price that they are trying to get, we do say, hey, look, to get that price, we could structure a deal like this. It might take a little bit more time for you, but you will get to the price point that you will have, and it does take some operational capacity off of your plate. So we're evaluating different types of loans. We work with loan brokers. We are in contact with over 25 local and regional banks that we're always taking into consideration via the asset class. So we're helping those folks find the right banks to work with. And then on some of those, what I'll call more stabilized products and larger deals, absolutely, we're going to Freddie Mac and Fannie Mae to say, hey, look, this is an option for you to evaluate and see if you can figure out, the right debt. But, that being the largest part of your capital stack, obviously you have to take that into consideration. So great question, Tim. Hopefully we're able to answer that. Mitch, did you have anything to add to that answer?
I mean, in general, not necessarily. I mean, it's the challenging part of what we do is bridging that gap between what a seller believes that the property is worth and what a buyer believes what that property is worth. And I would just say, from the conversations that we've been having with both sellers and buyers, I would say that sellers are getting more. They're maybe not necessarily as flexible on price, but definitely getting flexible on just creative strategies to go about making something work, so that maybe cash on cash returns can be a little bit better versus what it might be going through a different asking price. So I really think what you said really hit on the head, but I think there is somewhat of a, maybe not necessarily a change in price, but a change in strategy to go about making a deal work. I do see a lot of the sellers and buyers on that side trying to get creative to make that stuff work.
Yeah, and we won't know, Tim, and anybody else that's listening, until we get an offer in front of an owner, right?
Right.
They may say that they're not interested, but once they start to see a structure, they have something to respond to, we can start to work on negotiating a deal on your behalf. One thing that we're doing as a firm is, we're asking all of our sellers, hey, when you purchase this property, did you purchase this property from a sanity or a vanity standpoint? And you might be asking me, like, what does that mean? Well, I think that most owners will say that, well, I was able to secure this deal through my superior negotiation and deal finding skill sets. Okay. And it made sense for you financially. That's correct. Yes, it did. And we're excited about the acquisition. It's been a good deal for us. Okay. Well, if that's the case, then why would we try to go sell your property using the vanity approach and the emotional approach, right? Because at your price point of $9 million, for example, that might not make sense financially, and it is more of a vanity play, right? And so we kind of flip that script back on to our sellers and say, hey, help me understand how you are coming up with that price point. And also, would you want us to try to sell your property using the approach that you didn't purchase it? And so that doesn't work all of the time, but it is our job as brokers and as advisors in the industry to be setting somewhat of realistic expectations to and with our clients. Now, that being said, guys, we're in a changing environment, right? So capital is now more liquid than it was 6 to 9 months ago. Interest rates, people have some clarity in regards to where interest rates could be going. So there's always this kind of slack in the market where people are trying to see, well, where's this shake out at, right? And so they want to test the market. And to that end, we tell our sellers and clients that are interested in testing the market, that's great. We can do that for 30 days, but we need to have a really good understanding that if that's not the case and we do not find any buyers at that price point, hey, we need to get realistic on our pricing, right? And be able to pivot and change that quickly. Thankfully, we've been in the industry long enough where we can probably not necessarily widely market it, but make some phone calls, get it out to some people, or we get some of that feedback really quickly and say, hey, hey, this is kind of what the market is at right now and where we're at. So those are some tools in our toolbox that we're trying to do. And hopefully other brokers or advisors are doing as well, but we are at the mercy of owners wanting to sell at a certain price. The other point that I would say, Tim, on all of this, point, and great question, by the way, so thanks for being here, is that, like, look, there's about $1.4 trillion of commercial real estate debt that needs to be refinanced, restructured, or sold in the next, coming 12 to 18 months. And so you've got this mix and this confluence of discretionary sellers who are saying, hey, this might be a good time to sell. I'm tracking the real estate market and, we're ready to sell, versus you also have these non-discretionary sellers saying, hey, my debt's coming up due and, our business plan didn't go the way that it should have, or we thought it was going to. Our adjustable rate mortgage is really crushing our cash flow. And so we have to sell. So there's going to be this confluence of, deal transaction volumes. And I think that Marcus and Millichap and some other groups have put out some really good research here just recently about this kind of point. So I foresee the next 15 months being a really strong commercial real estate transaction volume market. I mean, we're at 2016 levels right now, guys. We're at 2016 levels in regards to transaction volumes. Q3, the data is not completely in yet. It will be hopefully here in the next week or so, and we will be coming live to you on the Market Pulse, giving you an update on how Q3 went on all different asset classes. So stay tuned for that for sure. We will bring that to you live as soon as we have that market report put together. But we did have a better Q3 than we did last year this time. So we are seeing some decent movement in that, but we're still at 2016 levels in regards to transaction volume. So appreciate that. Tim, another great question. What interest rates are we seeing being accepted by sellers for seller financing? Other terms such as IO. Look, I mean, it is all across the board on this front. It depends on how long they're asking for, how much money they're putting down, how strong they are in regards to a borrower, right? Because the seller still has to finance the deal if they own it outright. They're still going to look at, is this borrower, do they have the ability to actually repay this loan if something goes wrong? All of those things. So there's a lot of factors in that. I'd say typically 5 to 7% interest rate, 2 to 5 years, and there is typically some interest-only period right now on that front. So that gives you some boundaries or some frameworks to kind of think on. So great questions, guys. Keep them coming. We'll answer them live as we can, but we're going to keep going. in regards to the presentation that we've got. The data points that we presented here today, they really present and paint kind of three clear investment themes. You've got the silver tsunami coming. By the way, we have a skilled nursing facility listed in a great location of Kansas City. The only active only active known certificate of need, completely gutted, value add play for you to come in and have a 75 to 150 bed skilled nursing facility in a great submarket of Kansas City to activate and get behind this tailwind of the silver tsunami. But we are seeing premium pricing supported by this demographic growth in the lifestyle demand. So active adult communities, right? 55 plus, some of these communities really starting to pop off and doing well. Maybe it's in an area next to hospitals, and you start at an active 55 plus community. Then you move to an assisted living community nearby. Then you move to more of a skilled nursing facility, right? So you have the ability to continue to kind of transition as you go through your beautiful life stages, right? So that's the first theme that I would say. And we've had some interesting conversations with investors on that front. Urban core repositioning. First and foremost, shout out to Beck Johnson. This guy's writing incredible articles on LinkedIn. Beck Johnson, he is here. Walnut Risk, right, Mitch? Walnut Risk?
It's Walnut.
Walnut Risk. Check him out for all of your insurance needs, but also go check out his newsletter because he's doing a lot of work in regards to taxes and strong towns, which is a book that I have dove into in detail. But long story short, the article that he posted last night or yesterday, or maybe it was a week ago, I don't know, that I responded to was, back in 1950, Kansas City had like 80 square miles. And our population was like 455,000 people. Fast forward to 2025, we have over 500 square miles and 550,000 people. So the hard part about that is when suburbs come into play and people move to Liberty, they move to Blue Springs, and they move to Lee Summit, and they move across the state line to Overland Park or Leawood or Merriam or Lenexa or Olathe or DeSoto, wherever they go, we have this huge amount of land and roads to take care of, right? But we have these revitalizing areas such as the urban core in Midtown and Westport and the Crossroads where you really can find some yield. And these are operational intensive. They can be, but they can be high upside assets. More and more people are moving back downtown to those areas, and it's been really cool to watch. West Bottoms is an incredible case study to continue to watch here. So I think urban core repositioning is another theme to keep on your radar for sure. But you can't ignore the suburban family. We are in Missouri, we are in Kansas, we are Midwestern folks. Okay, so we are Midwestern folks. I was talking to somebody from California the other day, and I was like, look, people still get married at like 26, 27, and they start having babies, and then they move to a house and they get a school going, right? Like they go to the school. So you think about Johnson County, think about Lee Summit and Overland Park. These are all stable fundamentals and long-term rent growth. So those are areas that we absolutely target. So anyways, those are three, I think, key themes that we're kind of seeing in the data, but also we want to kind of call out here. Mitch, did I miss anything on that front?
No, I think just the signs that you kind of talked about on the, the adult side of things, adult communities. I've been in Kansas City now for over 12, 13 years and seen massive apartment complexes that used to house the 20-year-olds that are now flipped over to 55 plus communities. And as you'd mentioned, just set up right next to hospitals. So there's some opportunities just to continue to reposition or, convert those from just your traditional multifamily into adult living side of things. So yeah, I just wanted to double check or double down on that one.
Most definitely. And Carrie, I just sent you another note back here. You want to connect? Absolutely. Send me a message. This is what this is all about, right? We're here active in the commercial real estate space, the multifamily space in Kansas City MSA. And if you're interested in learning more about that, and over $50 million worth of listings that we have either actively listed or off market that we're working on, please do reach out to us. We've got some really unique opportunities ranging from all the way down to 5% cap rate for a brand new multifamily property, 100% stabilized. We're bringing that to market here soon. and it's close to a 6% cap rate, all the way up to value add opportunistic deals that have a return on yield or a return on cost, close to 25-30%. So we are not just one trick pony. We have opportunities in land, skilled nursing facilities, retail, industrial, multifamily. So please do office. Please do reach out to us if one of those asset classes is of interest to you. So, Mitch, you and I kind of spoke about this a little bit, the cap rate landscape, right? I mean, and the average cap rate across the board here needs to be taken with a grain of salt, because this is obviously marketed cap rates, but also everyone that I have met, calculates a cap rate a little bit different. But do your best on giving a cap rate landscape for the listeners here today.
Well, I mean, we'll kind of cover what you can expect off of those marketed cap rates being, the 4 to 6. It's really going to be your low lift, plug in and play, institutional buys from that side, where you're really going to see maybe some opportunities that are maybe a little bit more stabilized. Maybe you have some smaller opportunities to continue to force appreciation over time is going to be in that 6 to 8. And then when you're really starting to get into like the heavy lift value add, you're going to start hitting, I'd even argue maybe 7 to 7+%, depending on where you're at in the Kansas City area. But, really what we want to show this slide for is that cap rate can be interpreted in a lot of different ways, between a deal cap rate, which is what you're evaluating, versus what the market cap rate is. So I really would just say in this scenario, and just kind of like what Carrie had mentioned, like we want to be able to help you guys underwrite these things and understand, us knowing the Kansas City landscape, both in the Kansas side and the Missouri side, we can give you a really good idea of, what is a good opportunity, what is maybe a little bit more of a risky opportunity, and how we can advise you through that, connecting you with the right individuals, connecting you with the right groups to make sure that you feel confident going in. If it's a 6 cap, going in there and saying, all right, we've got to do some work over time. Maybe it's not the cap rate that you wanted, but it's a cap rate that you can work with. And then we can show you how to get that up to, what your current deal cap rate might be at the moment, and what that might look like in the future when it maybe comes time to sell that again. So I think that's just the big thing, is understanding what your expectations are when you see those cap rates, but not to take it for word. We can help you kind of underwrite that and figure out what a true cap rate is going to look like and where it might be able to get your NOI up, to help you with whatever cap rate that might be. Anything else you want to add to that, Logan?
Yeah, I think it also shows that how investors are valuing operational risk, right? Not just market risk, but operational risk. In today's environment, execution is everything. Prices on everything are going up. Construction costs up, labor costs up, if you can find labor, right? So just keep that in mind. I think it's how people are valuing this operational risk, and that's something that you need to be thinking about on a regular basis as well. So, and also, I think the last point that I'll make just on this is, from a cap rate standpoint, I've got investors that don't look at cap rates, right? It's like, look, my business plan is to go in and do X, Y, and Z over the next 5 to 10 years. And I don't care what my going in cap rate is. I'm looking at my basis. And what is my basis right now? Where do I think the basis might be in the next 5, 7, 10 years? Do I believe that Kansas City is on a growth trajectory, and this land and property is going to continue to increase in value regardless? Those are all things that investors must take into consideration. So I think people get fixated on cap rates, but I think that some of the smart money and smart investors are thinking about their business plan, operational risk, and their current basis in that property. So those are some things that I would like to add to that. So from a market observation, Mitch, tell us some things that are standing out, because we've presented a lot of information. We've got some other, investment implications that we'll talk through, but just from your perspective, working in the industry on a regular basis, being an owner and investor yourself, what are some things that might stand out to you that we kind of uncovered?
Yeah, I think there's really 3 key observations that really have kind of stood out to me as we evaluated what's out there in the moment. And that number one is just going to be that large pricing variance, from a $10,000 per door to $400,000 per door is a large variance that needs to be looked at closely when you're, looking at different opportunities. And again, what we just mentioned before is just kind of, what is your risk appetite? What are you trying to accomplish? How active do you want to be in those investments? The second one is that Johnson County just continues to remain a premium intact with continued investor demand in those areas. With driving down 119th and Row, you're going to see a lot of cranes in the air, a lot of plywood and lumber going up, building multiple different, multifamily opportunities out there. So it continues to grow and expand, and is a great opportunity for maybe just that less intensive investor to come in and, park some money for a little bit and just gain the, don't know if I'd use the word forced appreciation, but just enjoy the ride that is coming with Kansas City, with more and more people moving to the city here. And then, as we mentioned, go ahead.
It's just a powerhouse, right? I mean, it's attracting new companies coming down there. There's talks of the stadium going down there for baseball. I don't think that'll ever happen, but just to be on the radar for that, you got to remember that, the demographics in that area are some of the best in the country. Believing or driving down, those streets, 135th, 119th, just starting from state line and going west. It's one of my drive routes every time somebody comes into town that I'm with them, because we drive down that and you see Shields, and you see the old Sprint campus, which is now a Aspiria campus. You see the retail. You've got all these furniture stores that just look like absolute monstrosities, and you're like, how does Restoration Hardware or our house actually make it there, right? Well, figured it out, right? Town Center had just recently sold to an institutional group for a massive figure. Pfizer coming down to Johnson County, signing a 425,000 square foot lease. Like, it is happening in that area. So it's a powerhouse for sure.
Yeah. And I would say just the third observation is just we got about 5,500 units coming online over the next, I don't remember the timeline of that, but just the development side is continuing to grow. But, we've got some work to do to fill those as well. So that's kind of what has stood out to me over what we have seen through the multifamily momentum here in Kansas City.
Yeah, most definitely. It's definitely encouraging, especially given where interest rates are. I mean, developers are being cautious, but they're not retreating, right? I mean, that's the confidence in kind of Kansas City's fundamentals. And look, guys, I mean, the Kansas City multifamily market is mature. It's diversified, and it's still offering opportunities across all the risk return profiles. Okay, you've got stability in the suburbs, you've got yield in the core, and you've got growth in the pipeline. The key is knowing which submarket fits your investment thesis. And so, I was talking with Mitch earlier today, and I was like, somebody's always asking me, how do you find these 1031 exchange clients, Logan? I was like, well, you can't do it trying to pay for them per click, because the DST companies are paying $7 to $9 per click for these leads. So you work with these individuals on an actual strategic advisory standpoint. You do analysis of their portfolio. You give them investment scenarios. You put deals in front of them. And it might take 3, 6, 9 months, but that's how I have been able to create repeat clients over the years, is making those decisions. I mean, there's not one of those meetings where I say, I don't leave and I say, do not rush this. Like, you do not want to rush this. Like, I'm like, well, man, I don't really hear that from a real estate broker trying to sell me real estate deals. But I know if I get you into a great deal that fits your criterion and it goes well for the first 12, 24, 36 months, you may call me and say, hey, I'm ready to trade up. Or, hey, I'm going to refinance this deal and pull some cash out, and I'm ready to go buy another one, right? And that's the whole business model of real estate brokerage, is not doing these one-off transactions. It's building a relationship, being a strategic advisor, and moving your portfolio in the right direction. And so we're kind of blending this anecdotal data, because everything that we report on here typically is, rear facing. And so you have to talk with us to see through the windshield and not looking through the rear view mirror. And I think that's where the data sort of gives us that clarity, whether you're underwriting, a 20 unit value add or a 200 unit stabilized deal. I mean, you have the opportunity to talk with some folks that are in the industry on a regular basis. And that's where, like, people get this paralysis by analysis and like, well, how do we make that jump? And I'm like, well, how much time do you want to spend together? And, because it's going to be these conversations that we're going to be having over the next 3, 6, 9 months that are going to help you feel comfortable taking that next step forward. So that's what we're here to do. And it's our job to go have full enough pipelines on the backside of things where we're not pressuring you guys to actually be making decisions and trying to put this urgency. Now, we will gently apply that pressure to say, hey, you need to move on this, right? Like this is going to go, and you need to make a move. But we're not going to be, this pushy kind of salespeople in regards to, trying to put people in deals that they shouldn't be in. So those are some more points that I wanted to kind of think about as well. So, Mitch, look, today our goal with this analysis, which I know we're 10 minutes over our allotted time. That's what happens when I start talking, was just trying to make sense of noise, right? To kind of turn the data into direction. And, Mitch, I think this work allows us to see the market in real time, position our clients for the next wave of opportunities. So we obviously love to discuss how these opportunities, this data translates into actionable strategy for your portfolio. We are always working on active deals, and we have all of that information readily available to send to you to be able to review, but you do need to reach out to us. Mitch, if people want to get in touch with you, man, how are they supposed to do it?
Yeah, well, first, an easy way to contact is just the activity on LinkedIn. Both yourself and myself are great ways, but we'll put up some contact information here in a little bit. But what I really want to hit on is exactly what you talked about before, Logan, is just that these things take time. And something that stands out, Logan, that you oftentimes said is, there's a difference between being fast and quick.
Yeah.
And trying to understand, all right, let's take the time to know what your strategy is, what you want to focus on, how active you want to be. And once we can really get nailed down into that by building that relationship with you, then we need to be quick when it's time to move forward on opportunities that present themselves. But we're here to help you look at different comps, obviously going through this market insight, doing underwriting to help you do that and make sure that we're able to dig into specifically what it is that you were looking for. And then, if you're an out of town investor, like let us use us that live here to be able to give you the I can't even word the specifics about each part of Kansas City that one area can be completely different than the next. And that's probably likely in most metros, but we're here to be able to support you guys on that. So feel free to reach out, email us. As Logan had mentioned before, we've got a lot of investors right now looking to unlock that equity to increase their return. And, we're here to help you with that.
Yeah, most definitely, guys. So, key takeaway from today, right? We got a market depth of around 2,600 units listed, which suggests strong liquidity and active investment environment across $195 million of multifamily inventory. All right. So there are products out there. There is an opportunity to evaluate those. We were looking at just specifically for one 1031 exchange investor before this call, price points between 1.2 and $2.5 million, right? There's 26 properties across the MSA for you to evaluate. I bet one is going to be enough, meet enough of your criteria to be able to at least dive into it a little bit deeper. So that's what we're here to definitely do for you guys. Mitch, we do have just one more question that I wanted to bring up real quick. So let me get that up on the screen for us so we can evaluate this. Tim, appreciate your question. From our perspectives, what's been the biggest challenge in helping investors see the upside in KC multifamily? And do we find that out-of-state investors still underestimate Kansas City fundamentals compared to higher profile metros? Tim, I don't think that we have a hard time getting them to see the upside because now the data shows it, right? And so Overland Park, Lee Summit, Olathe, all these places kind of putting, on these lists of highest rent growth and also, being able to be best places to live in America, being on those lists, I think gets a lot of play. The Chiefs and Taylor Swift obviously have given Kansas City literally a lift in regards to that. And all of you haters out there, I don't know if you watched the game last weekend, but the Chiefs look like they're back. So anyways, I will say that, more than anything, Tim, it is just getting Kansas City on their radar. It's like, hey, this is an option, right? It's like, they're like, they don't even know where Kansas City is or what is going on in Kansas City. Big thing for Mitch and I, if somebody's really interested in learning about these markets, we urge them to come. It's $300, $400 to get to Kansas City, depending on where you're located, right? Maybe you could even drive. but come spend some time with us in the market. And there is, after everybody leaves from those market tours, there is no doubt in their minds that Kansas City is on the upswing, and there's a lot going on there from a multifamily standpoint. Mitch, what would you like to add to that?
I always go back to this, like the personal side for me is I have a sister that lives in Los Angeles, and most of her friends out there think that Kansas City is truly cow town, and like we experience tornadoes every other minute of the day. And, that's just not the case. It is a booming metro. It is quickly growing. It's a desired place to be. And, having moved here 12 years ago, like I've been to a lot of other cities, and it just continues to be one of those hometown where it's big enough that you can feel like you're in a major metro, while at the same time it's small enough to feel like you can know your neighbor really well. So, it's just maybe a little bit biased to that perspective, but yeah, come on out. Let's hang out. Let's get you some KC barbecue. We can run you by the Chiefs Stadium and show you what Kansas City has and what it will be over the next 10, 15 plus years.
Absolutely. You can check us out, find all of our active listings on www.mwcreadvisors.com. Obviously, engage with us on LinkedIn. No less than 20 people have reached out to us in this month alone. We have had active conversations with those investors, with those people looking to partner with us in regards to buying real estate here in Kansas City. So make sure to drop in, slide into Mitch's DMs, slide into my DMs. You're going to get pushed over to Mitch anyway, so you might as well just reach out to Mitch. But anyways, if you're interested in Kansas City, let us know. If you're an owner and you're like, hey, I own some property in Kansas City, you want a real objective perspective, like, hey, I will give you a property performance audit. We can do that really quickly. Yeah. So if you get us the information, I can get you something turned around in 24 to 48 hours. So make sure to reach out to us on that front as well. Next week, on the Market Pulse, we have an incredible guest. Corey Zelnick is going to be on the show. He's been doing real estate for longer than I've been alive. I don't know if that's accurate or not, but I'm pretty sure he has been. So he's in New York City. He's a retail broker. He is good friends with all of the New York City brokers. I'm super excited to learn from Corey, to hear his journey, hear his story, where he thinks the industry is, where it's headed, and just really diving into some good stories about commercial real estate. So check us out on that front. And then when the Q3 numbers get published and we can find on all the asset classes, we'll be aggregating all that information, putting it into a market report for you guys. You need to be on our newsletters to do that. You can check out my newsletter on LinkedIn, but definitely just go over to our website and hit contact us, get on our newsletter so you can get that market report. But we'll be bringing it live for free here in a couple of weeks and going through every single asset class, similar to the multifamily market, talking about transaction volumes, where's the capital flowing, what should you be thinking about. So thanks for being here. We had an incredible showing today on Tuesday, October 14th. So thank you for being here. We appreciate all the questions coming in. If we didn't get to one, make sure to just shoot us a message. We'll get to it and we'll get back to you. So thanks again for episode 38 of the Kansas City Commercial Real Estate Market Pulse. Mitch, great work, and thanks for being here.
You bet, man. Thanks for having me again.
We'll see you guys next week.